You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live every Friday at 3 p.m. Central, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That funky tune, I love that tune. Gets me in the mood for some futures options. Welcome to TWIFO. This Week in Futures Options, as the name implies, it's the program on the network where we break down all the latest developments in the week that was from all of the different commodity and futures options products out there. A little bit of gold, a little bit of crude oil, a little bit of maybe soybeans, maybe throw in some lean hogs and whatever else is catching our eye that week. And you have the heady brew that is TWIFO. Some of you, the astute amongst you, may have noticed there was no TWIFO this week, so you didn't get your update, last week for last week's episode, and we apologize for that. Of course, it was during the height of the big options industry conference, and that tends to wreak havoc with our recording schedule, so we apologize to you for that. We're going to try to do our darndest to do a little double duty for you this week and give you a good rundown. My name is, of course, Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting up to 14 programs now, Options Insider Radio Network. And, of course, the easiest place to find all of that goodness, the mothership, theoptionsinsider.com, or, of course, via your favorite iTunes or whatever place you get your podcast programs. Tune in, Stitcher, even a lot of you on the Google Play side. And, of course, you can always just grab our mobile app, available for iOS, Android, and the beloved Fire OS. And joining me on the old program today, he and I had the privilege of participating on the Future of the Industry Technology panel at the OIC conference last week. That was very fun. If you haven't had a chance, check it out. Keep tuned to our network. All the panel audio coming out from us. You'll have a chance to hear that very soon. He is, of course, the founder of Bantix Technologies and the creator of a little software platform we like to call QuickStrike here, Mr. Nick Howard. Nick, welcome back to This Week in Futures Options, sir.
Good to be back. Sorry again for not being out there last week, guys. We had it scheduled. We had a little snafu with all the activity going on, but we're here today. We'll talk a little bit about last week because that's going to set up some of the conversation for today. But look forward to getting started.
Let's just do that then. Let's get started, Nick. And it's funny, we talk a lot about crude oil on this program, and indeed, crude seems to have dominated much of the commodity and futures options discussion for the better part of the last year, dating back almost about a year and a half now, a little more actually, to about October of the year previous when that big sell-off really started in earnest. So it seems like crude has been leading the conversation. Of course, gold raises its ugly head every now and then as well in the conversation, but something that's really been catching a lot of people's interest, maybe caught some people off guard with this activity of late, have been the soybeans. Nick, I don't think when you and I first conceived of this program, we'd be talking about soybeans this much, but that's kind of the fun of this program. It's not always the same thing every week. It's going to be mixing it up a little bit with what's hot that week. And this week, yet again, and of course last week when we were off, the beans have been rocking and rolling out there. We're seeing a lot of interesting moves, not just in the underlying. We saw some limit up, limit down moves of late. We're also seeing a lot of interest in terms of changes and developments in the volatility. And of course, what that means for the volatility skew as well as some interesting activity. So let's start there, Nick, because that seems to be where actually it's managing to usurp interest in crude oil amongst our listeners these days, which is certainly saying something. I know you've had a lot of time over the last week and a half, almost 2 weeks now, to watch a lot of the developments that's been going on out there in the beans. So let's start there. What's really been catching your eye over the last 2 weeks now? Not just this week, but the last 2 weeks out there in the land of all things soybeans?
Yeah, well, I think the interesting thing is, when we started the show, we did start to see a little bit of a rally in the beans, and then obviously a great interest in the options with an increase in the volatility. And then, as we've been talking about, just the calls becoming much more fashionable in terms of the vol levels, calls being bid and the puts being offered in a sense. So you're getting a real tilt on the vol curve. But, and that was precipitated by, well, no pun intended, precipitation down in Brazil, which, put a little bit of a price increase on the expectation of the bean crop going forward. And that was probably 3 weeks ago, I think, right? Or maybe 4 weeks ago when we started to do that.
About that,
so, yeah, we had a little, we had some, an increase in the beans, and that was sort of what people were looking at as what was causing the rally. Well, then all of a sudden last week, right, we thought we hit a spot, the 1050 mark, maybe it was, where did we start out at the beginning of last week, about the 1034 mark in the front month, and all of a sudden we're trading up to 1065, and a lot of the activity happened on the 10th, which was a Tuesday, I believe, right? I think that was a Tuesday. When that was the USDA report, and what we had was then basically there was a crop production expectation that it was decreasing by several million bushels available. So we had a limit up gap basically, and frankly, I come from a market, the Eurodollars that we've talked about before, never really had a price limits up or down, but there was a limit up gap up, and a lot of activity on that day. And, then it sort of threw another thing into the mix in terms of where all this price action was coming from. So,
hey, Nick, I don't mean to cut you off, but let's maybe get into that a little bit before we go any further. I know we have a lot of listeners who are maybe tuning in, learning about commodity and futures options for the first time. And like you, and certainly like me when I first started looking at these, they had never really been exposed to a limit up, limit down environment. You don't really have those in the equity and index options unless you have a circuit breaker trigger, which is a very rare event. So maybe walk our listeners, before we even go any farther into the beans, walk them through kind of what happens in that limit up, limit down scenario. Obviously things halt, what tends to happen from a liquidity and order perspective, and kind of how does all that play out? So maybe some of our listeners who have never been through a beans limit up before, they could have some sense of how that plays out in the options market.
Yeah, well, I'll do my best to relay that information, because I'm actually just learning about it myself, because I asked a lot of questions when it happened, because And I'll give you a little history, if that's okay, of why that question even came up. We supply historical data, and Mark and I have talked extensively about our quick skew numbers. And as we looked back in our history, we're seeing some oddball sort of outlier points in some of the derived data that we had, and it ended up being on those days there were limit up moves. And what happened is that the future, if you close limit up, the future stops trading, right? So, and it's stuck at that point. So you could be limit up during the market, but the options still keep trading, right? But then if you get to the close, the market stuck at that. There's a settlement for that future at that price, but then the options continue to trade. So the options trade synthetically during the day. So you really have to get your underlying price by doing taking the call minus the put, the absolute value of that, and adding it to the strike, and that gets you really where the market thinks the futures price is. So it's interesting how intraday the futures can be pegged up or down. It means they stop trading. You've got to put your bids and offers in at those prices, but the options still continue to trade. So the good thing about last week was there was a limit up move, but it was early enough in the day that then when the trading resumed, there was still time in the market for things to settle down and for the options to catch up with the future. So that's sort of the nickel explanation for how that works. So the options still keep trading when the market gets pegged up or down, and you have to do your synthetics. So if you're trading in a limit up market, or you're looking at option prices in the limit up market, you have to get a synthetic future and determine how those option prices are going to be priced from there. So I learned that over the last month because, like I said, I'm learning as we go along in this too, especially given that I'm generally new to the commodities, and both and even outside of the rates, my experience is what I've just gained by supporting those products in quick strike. So that's sort of the first interesting thing. But we did have that limit up on Tuesday of last week. That was our big gap up, and that drove a lot of activity. So not only, like I started to say, now there was two variables in the market that were sort of pushing it. It was weather, and then it was the fundamentals, which was the USDA report. And interestingly enough, and this is sort of what I'm coming to grips with too, and Mark, and I'm sure you have the same sentiment, given that you're somewhat new to the commodity markets, just from the detail that we've been talking about them, is that there's always going to be traders out there speculating and looking at price action and looking at the charts and looking at the patterns formed and stuff like that. So that's really that at times will dictate where price is. But when it comes right down to it, this of all things, this is a fundamentally driven market. So these prices are going to be determined by what happens, what's going on in the world, what's happening on the farms, how things are being harvested. Is it wet? Is it dry? What's the expectation of the supply? That type of thing. So there's as much as there's technicals around it, there are these fundamentals. So you really have to be well versed in what's going on. So it's a little bit different of a market watch that you have to make.
It's funny. I think you just blew a lot of our listeners' minds, because the notion that the underlying halts and then the options keep trading, that's not a scenario that you really can encounter very frequently in the equity and index side of the fence, because most times when the underlying is halted for whatever reason, then the options are going to be halted too. You don't have a lot of times and you don't have an after-hour scenario here where you can trade options with a kind of a stuck underlying or anything along those lines. So the number of times that a traditional equity, your Facebook or Apple or SPY options trader is going to encounter a scenario like that are few and far between. So I think we just blew a lot of people's minds here, Nick, let alone the notion that now they have to go back and actually remember their synthetics, their put call parity. And we talk about those, some of our other programs and some of the importance of understanding that. And certainly it is important, but they don't have many use cases where they can actually need to utilize that in a live kind of real-time basis to gauge a lot of their trading. And yet that's pretty much in those environments the only way you can really have a handle on where the underlying is, or where the range where the market thinks it is, by doing your synthetics out there. So yeah, I think maybe we just terrify a lot of people from trading these products. I don't know, Nick. Maybe we're doing a disservice to ourselves, but that's kind of the kind of nuances you have to learn and understand if you're going to really navigate these markets. And certainly, I think navigate is the right term. These have been very choppy, very turbulent waters when it comes certainly to soybeans of late. And if you're just diving out there for the first time, you don't really know much about the fundamentals, like you mentioned, or indeed how these limit up, limit down scenarios, how the options still trade in those kind of environments. I think you're going to be in for a rude awakening, wouldn't you say, Nick?
Yeah, I think putting fear into people is probably unwarranted a little bit, only because you shouldn't be afraid. If you go look back historically, the number of times limit up has occurred is very minimal. So, but the important thing is to realize that happens. And I just think from a, could even be something as simple as you're looking at some historical data and the people providing it. It could be, we've gone back and fixed ours, but the people providing it could have just taken the settlements and imply the volatilities given the current futures price, and you're going to get bad volatility. So if you were to see like a bad data in a historical, you could go and look back, like I think it was March 28th of 2013 was the one that we saw the last time. That was the last one we saw, and that's how we realized it. So it's just sort of knowing that nuance that's going to give you a little bit more of an idea of how to look at that market. And plus, you know what? As a former market maker, it never is bad to practice your synthetics, because you got to be good at that short digit math, quick and dirty.
Yeah,
that's the way to do it.
It's helpful to have a working knowledge, working understanding of those synthetics. Speaking of working understanding, I know, Nick, you've been, in addition to traveling out to LA and back again, and all the stuff we had to do for the conference last week. I know these markets have been so tumultuous of late out in soybeans that they've actually been catching your eye from a trading perspective. You're starting to work a few positions out here to kind of get more of a practical feel for how they perform from a futures options perspective. So walk our listeners through exactly what's been catching your eye out there, how they've been performing, and maybe any interesting developments or surprises you've seen as a result of that over the last couple of weeks.
Sure. I think that's the fun part, right? So trading might be I've been paper trading, because as you've heard Mark and I discuss over the last few weeks, there is a new tool or report that's going to be available, and we're not exactly sure. Again, we've been calling it quick skew, but it essentially lets you look and see how overvalued or undervalued the out of the money options are in relation to each other, as well as to the at the money. So what I try to do is, if you're going to present this as a practical solution for people to look for trade ideas, you might as well have some ammo to discuss it when the time comes to say, well, how does it work, right? So what I started to look at was in this rally, you saw it in gold too, where sort of the different, when on the rally the calls get really big, on the breaks the puts get really big. So you start to see this kind of wave pattern in terms of how the calls and puts move in relationship to each other, right? How the curve tilts and all that kind of thing. So with the beans, over the last few weeks, you started to see a big bid in the calls and some offering in the puts. So there was a little bit of divergence in terms of the out of the money options as well. So basically you got some tilting of the curve, so it looked more like a line, sort of like a slash, one direction or another. In this case, the slash was going from the top right to the bottom left, because the calls were bid and the puts were offered. So I figured, okay. There's some vol disparity, right? Anybody who's traded volatility, the idea is to buy the low volatility and sell the high volatility, right? Would you agree with me, for more or less?
That tends to be the best way to do it. You can maybe try other ways, but that's the most tried and true method I've found.
Right. Or some people just believe in selling the high volatility and not buying any volatility. So
you never buy the options back; they only expire worthless. That's always how it works out for me. I'm not sure about you, Nick, but you never. Options are insurance. You don't buy insurance; you sell it, right?
That's right. Well, if that's the case, then God bless you. But so what I try to do is I wanted to put on some of these. I put on some of these plays to see what they look like, right? And so I was buying the cheap option and selling the expensive, and I just tried a few different things. Now, keep in mind, I think I put them on post the Brazilian news with the rain down in South America and prior to the USDA. So, you can imagine what happens to a 1x2 where you're long at the money and short two wings on a 30-point rally, right? So it looks pretty dirty and ugly when it's all said and done. But the reality is, when you look at it from a practical standpoint, for instance, when you have an expensive call, an inexpensive put, okay, and let's just call it in the 25 delta range, whatever you want to do. So you can start to pick strikes that are out around those values. You don't have to be perfect, and so what one thing that I did that I like, and I think the trade right now is about flat. So that's like I have one that's up, a couple that are down, one that's flat, and the one that's up is pretty good, but the one I like, and I think I like it the best, because it's almost like a hedged position. Because when you're trading vol, typically you are you expect the vols to come back in line, so you should generally hedge that position, right? So some of these I hedged, some of these I didn't hedge, but the one I like was where I bought the cheap wing, I sold the expensive wing, and then I synthetically. So you basically, what do you call it? You guys call it a fence. I call it a risk reversal or a squash. What do you guys call that? When
risk
you buy
reversal. A risk reversal. I've heard them called risk reversal. Sometimes rah-rahs, which I never liked because people are just too lazy to say risk reversal. But yeah, mostly risk reversal. Obviously, if it's a bearish risk reversal, it can also be a collar. But effectively, those are the two.
I was looking at. Yeah, right. So you collar, a risk reversal, squash, however you want to combo, whatever you want to look like it. So I was buying the cheap, selling the expensive, and then hedging it with a synthetic future at the money. So you're basically buying the call and selling the put. And I like that one because you are covered. So it's basically like selling a call spread or selling a call spread and buying a put spread, right? So that's really what it comes down to. So you can imagine what that looks like. And that thing throughout this whole tumult, that one has reacted the best, right? Because you can imagine you on the rally, you're moving away from your short and towards your long. So, it sort of took care of itself. A couple of the, you could go just look at a pricing sheet and see, well, which strikes are expensive, which are cheap, and especially when you're noticing. And you could look at TWIO really, or TWIFO. I call it two names. I got one name somewhere else and one name for the show. You can go on TWIFO as an example and take a look at the 25 delta risk reversal. That's a call minus put, and you could see where that value is trading, right? So if you see a high positive number, that means the calls are really bid over the puts. You see a large negative number, that means the puts are really bid over the calls. But that's kind of what you can start looking at, is looking at for numbers that are going to give you a tell in terms of when something might be interesting. And more importantly, if you can watch that number over time and see how it changes, or you can even go back and look at that number historically, which is the intent of what the report's going to do, is that then you can see how it's reacted, what maybe the right time was, or just how long you had to wait to realize some gain. So as far as something else that sort of hurt a little bit in terms of what I put on, this is a pretty typical way, and you would expect it to hurt. I put on a couple. I put on a short dated 1x2, buying the call and selling the twice the expensive calls, and I did that one in July and one in October. And when you look at it if you look at it from a current price standpoint versus where you traded it, clearly the P&L hurts. But when you look at it from a placement, and it depends again on what strikes you are. I think on the what did I do on the November? I did a 980, 1080, 1x2, buying one, selling two. You look at it from where your current valuation is, and it looks like it hurts. But when you start to look at it as the future's moving within that range and how much range you have before you actually break even, it doesn't look too bad, right? Because the 1x2 essentially looks like a sickle, instead of with a sickle, that you use to cut the wheat or the down. Instead of having a round blade, it's got a triangular blade. So, you got the peak up at the top. So when you start to look at the break-even charts, it might look painful from a P&L standpoint, but from a practical standpoint of where you really have to work with in terms of your futures range, it looks pretty good. So those are the kind of things I'm looking at. And again, I think that's what most people are trying to do, is looking for undervalue, looking for overvalue, selling overvalue, buying undervalue, and maybe even playing them against each other. But I think the most important thing, as I changed the way I was, and again, this is all a learning experience. That's the whole idea behind, doing these paper trades, is I wanted to always start the trade out as delta neutral. So I was ratioing the options enough to the point where I came out with a zero or close to zero delta. So some interesting things. And I'm glad if anybody has any interest in seeing those, I'm glad to generate PDFs of all I've done 4 of them. I'm glad to generate, and they have the trade dates on them and everything, what the price I traded it and where it is currently. I'll create links that you all can open and take a look at it and then play with it as well. That's a service that's available from QuickStrike. We create links to trade strategies to allow customers to take a look at things and play with them. So Mark, you say the word and I'll generate those links and we'll give our users a chance to look at them.
That'd be kind of cool. And they can always mock us for our timing in and out of some of these trades. But I think that's a worthwhile endeavor for them. And certainly as you guys ramp up that quick skew over there and make it maybe a premium offering over there on the QuickStrike side, that is a pretty cool tool. And as I've said before on the show, I don't know really anyone else who's breaking down skew, not just in futures options, but across any real product, to that degree of specificity. The movement in the call wing and the put wing, again, skew is often disseminated as one number, but it's not one thing. It's two different things, and they can move in conjunction. They can move in different directions, and the net result is what gives you that one number. So when you have people just talking about skew as one number, I've never really found it all that informative, but it's never really been a good way to break it down until we have analysis of this quick skew. And it's also, like Nick just outlined, it's a great tool to use to maybe start lining up some of these types of trades. And when you're talking volatility skew, risk reversals are typically the way to play it. You can go strangles as well, obviously. If you want something that's going to spread away from the at-the-money, give you exposure to those wings, and you look at that tool and you can say, wait a minute, the calls are cheap. The puts are kind of bid up, so I'm going to go maybe for the old school bullish risk reversal. Sell the puts, sell the put wing, buy the call wing, get some exposure that way. Obviously, that'll have to stay in line with your underlying exposure as well. You can do it the way Nick does it. Keep things delta neutral. The old school market maker still shining forth in you, Nick, slinging things delta neutral. That might be kind of cool to put forth some of these PDFs and some trading ideas, because soybeans have been where it's at of late. Nick, let's we've been talking soybeans for a while. Let's hit on a couple of little, maybe some strikes and activity that's really been catching our eye over the past couple of weeks, and then whatever time we have remaining, we'll see if we can squeeze in a little bit of crude, because we got to talk crude too, right?
Yeah, for sure. And yeah, first off, just so everybody realizes, I'm not a CTA or anything like that. I'm just a guy who used to trade, who has a software product now, and I still look at the markets. So I always have ideas if people call me, and if the brokers that are my customers call me and ask me about some certain markets and questions about volatility, I clearly have an opinion, but I don't offer anything up to anybody from a service standpoint. This is all meant to be theoretical and helpful from an educational and maybe from an idea generation standpoint. But
too late. It's all legally binding, sir. You are now an official
we're all
CTA.
Done. That's it. It's finished.
Here comes the CFTC. I think they're knocking on my door as we speak, and the NFA. So let me go answer that while you go talk about crude.
We're gonna have to change the lead in to put a disclaimer, and all ideas here are from a technical guy behind his desk.
Exactly.
And that's it.
These are for fun. Information only.
Yeah, information only, right? That's always seems to be the first lead into any kind of webinar that I'm participate or that I watch. Everybody wants to disclaim themselves.
Well, it works.
But as far as what's interesting, again, I'll reiterate. Like today, I was watching it as we were getting ready for the show. I mean, we were trading down around. The beans are around 1070 right now, or that's where they closed until Globex opened. But we traded down to like 1051, and that first of all, that seems to be sort of the lower bound right now for the charts. And again, I'm not a technician or anything like that, but just if you use your common sense and see where things have traded and how they've sort of played out over this week, that seems to be a lower bound right now. And we're generally flat for the week. We're up 5 cents, but I'm going to call that flat only because of the way it traded today. And the other thing that Mark and I wanted to make sure that we mentioned was the low is 1051, but when you looked at a price action called VWAP, or volume weighted average price, it takes the volume and it multiplies it by the price, and then it's divided by the total volume, so you can kind of get an idea of where all that activity was at what price level. So interestingly enough, the VWAP on the front contract in the beans is was a lot higher than its 1051 level. So I think the lowest it got to was, if I look now, it was about 1063 and a half. So so that means our gap down today from 1070 down to 10, or around 1070 down to 1051 was sort of empty, right? So there wasn't a lot of volume on the trade down. So you're going to see a higher price in the VWAP. And again, that's something that you can get via Quick Strike. And I think more than likely it's going to be available for free by way of the CME Group website, where most of these tools preside. And we should probably mention it again. TWIFO is available as TWIO because they are a futures options exchange. We don't put the future in there, on cmegroup.com/TWIO. So you can go and take a look at that. And you could also go back and look at up to 2 weeks in history of the report itself, all available on the CME Group website. So anyway, as far as interesting stuff going on, I mean, the first thing to point out is that, again, for multiple weeks in a row, open interest is increasing in those in the products. And in the beans in particular. So that's first and foremost. There's lots of liquidity in these, and again, we're seeing a majority of liquidity in the front, the June contract, as well as the July contract, and also in the new crop contract, which is November, right? So if anybody, Mark, again, that's something we could probably start to do as well. There's a little table I can give you, and you can put out the link, and we can show when these crops get planted and when they get harvested, so people can start to understand the different parts of the.
That goes back to what we were saying before, the fundamentals and the nuances. There are so many nuances to understand when you're looking at all these products for the first time. The crop cycles, the crop reports, the different for the hogs, the different feed and slaughter seasons, and every different product has a different kind of season, a different use case, a different life cycle, and you kind of have to learn all of them if you're going to really start navigating these waters. Maybe that's a component we can add to the show going around too. Maybe a little quick hit on some different element of a particular product category that may be interesting to our listeners, and certainly probably they're encountering it for the first time. You don't typically have a new crop, old crop cycle when you're out there slinging apple puts in the weeklies, for example.
No, that's for sure. Well, no, that's part of the fun, right? I mean, and that's kind of why, sometimes you put yourself in a position to be forced to learn something because you're going to have to present it like we are, and it really puts you in a good situation for learning different things. So for today, the thing to keep in mind is that the current contracts in order are June, July, August, September, and November. So June, July, August, and September are the old crops. So that's all the crops that are already been harvested and are in storage somewhere. And then November, the X in the futures options world, that's the new crop. So that is where the harvest begins for the or ends in the beans, right? So you have September, October, November is the harvest for the new crop. So anyway, as far as activity goes, in terms of the biggest amount of volume, the front month, which is expiring tomorrow, had, of course, a lot of activity in the at the money strike. So not a tremendous amount of interesting things going on there in terms of people thinking that there was going to be a continued rally. I think there were probably a lot of trade around the money, and as we talked about a little bit earlier, that was sort of where we think the support is. So when you see a lot of activity around the straddle, it means people getting in and out, small change in the open interest, but not too much going on in terms of a change in the put call ratio from a volume standpoint this week, right? So it's really flat. So there wasn't a lot. So people were just trading, So that's if there are option people out there, they're scalping their gamma, right? So there's good activity. You're going to make some money that way if you're long some options. And then as far as the open interest, still a bias to the downside in general for the June and July. So that means we have in the terms that we're using it, we have a number greater than one, means the puts are more in fashion than the calls. So again, the June is expiring, so not much interest there, I think, going forward in terms of what we think, but still more people are long puts than calls. And then if we go out on the curve a little bit, some activity in the upside, 1,200 calls in August. Those were the high volume numbers for the day. 1080 calls out in September, and then almost 9,000, 1,100 calls in the new crop option. So some potential speculation out a little bit higher priced. And then the biggest opening out in the new crop is 1,500 calls, or $15. They're 1,500 that's represented as the strike, but they're the $15 calls, and that had a 100% increase in the open interest. So there's most of your activity. But again, if you take a look at, if you go out there and take a look at the report, you're going to be able to see all this firsthand, all the things we're talking about. And as Mark has mentioned in the past, all the sort of the key points are highlighted in the different colors. So you'll be able to catch those right away by taking a look.
Well, Nick, we went so deep into soybeans, I don't think we're going to have time for any other products or indeed any other segments right now. Hopefully this will tide you over. Again, we apologize for not putting out the show last week. And you're probably wondering, hey, why is the show coming out a little bit earlier this week? That's actually on me. I have to travel again at the end of the week, so we're recording one day earlier than usual. We're also not live streaming. If you're wondering, how come I'm not getting my live stream Fridays at 3? Don't worry, we'll be back to all those regular schedules next week. We wanted to make sure, though, you guys didn't have to wait any longer to get your TWIFO fix. I know you were waiting for us last week. We don't want to keep you waiting any longer. Record a little bit early so you guys can get your access to all of the juicy This Week in Futures Options goodness. And before we wrap up, Nick, and again, you guys have been sending in great questions. We'll get to them on future episodes as well in our Futures Options feedback segment. But before we wrap up, Nick, maybe really quickly, we've been talking about the skew and a lot of the other cool things that you guys are working on over there at QuickStrike. By the way, you guys can get access to it. Like Nick said, the easiest place to find it, cmegroup.com/TWIO, TWIO. Confusing. They leave the F off. Why do they do that? I don't know. Go ask CME. That's their link. It's not mine. But go to that link. The show is TWIFO. The link is TWIO. Confusing, but we can deal with it. And you can see all these reports for free and updated in real time, so you can see all the data coming up. So if you're listening to us as we're talking about the show, you can see exactly what we're talking about here in terms of what's been lighting it up in soybeans, like the 1,500 calls that Nick was just talking about, and some of the others, the 1080 calls, and some of the other strikes that have been lighting it up of late, as well as all the cool skew numbers and all that cool goodness. And before we go, Nick, really quickly, give us a little hint, a little tease. What else you guys cooking up over there in the land of QuickStrike?
Oh, let's see, boy. We just did a bunch of stuff release wise. So we're just lining stuff up so it's easier to get at everything is really what it comes down to. And I think the big thing that is probably worth mentioning is just keep an eye on the new reports that are going to be coming out from the new free reports, first off, that are going to be coming out on the CME Group website. And those are going to be just more in-depth pieces of information about volatility, and then also about, total open interest and how it relates to the market in terms of underlying equivalents, that type of thing, really to give you an idea of where you can trade and how liquid things are. And then as far as we're going, like I've said all along, we just continue to push forward and continue to try to create new things like quick skew. And I think the new one that I could throw out there, and I don't have a name for it, Mark. Maybe you guys can help me out with it. But this one is going to try to represent, as you start to move forward. In the term, right? The shorter dated options always seem to have an increase in volatility, right? Because that increase in volatility is helping the price to catch up, because the straddle price may not necessarily change from day to day, but that volatility is always going up. So we're probably going to do something called quick decay or quick theta vega or something like that. That's going to give people an indication of, you might see an increase in volatility as you approach as the term on as an option moves forward, but how much of that is really valid price and how much of it is based on just the vol trying to keep up with the amount of decay. So we're going to try to give you a way to look at decay in the short dated option, so you could see if it's worth basically, is it just worth selling this and leave it alone, and leaving it be. So that's, again, we're always trying to give you guys different ways to look at things, so that's hopefully going to come out fairly soon.
There you go, listeners. A lot of cool stuff coming down the pike from Nick and the team over there at Bantix. Probably the best way to find it is Bantix, BANTIX.com. That will link to you. Of course, you can always search for QuickStrike, but it's got a little bit different spelling. It's QUIKSTRIKE, or just follow them on Twitter at QuickStrike1. Again, that's with a K, no C. And on behalf of Nick and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show, for sending in such great questions, and of course for being so patient with us as we continue to evolve the schedule for the show. We'll get it down to a science by next week, I assure you. And we'll see you next time for more of This Week in Futures Options.
This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at Bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.